Okay.
I sent y'all homework. Yes. And then tonight I know all of y'all won't go on y'all date. But I want to finish chapter 4 and would love to touch chapter 5, but I know y'all won't go on your date, so y'all gonna be reading chapter 5. Chapter 5 just totally deals with customer service. Yeah, customer service, the different products. Customer service, it's like chapter 5. Chapter 4 talks about trustee, Bailey, Baylor, principal and agent, pawnee, pawnee, creditor, debitor. And so, yeah, bank customer relations, merchant bankers, investment bankers, commercial and personal bankers. What is a customer? So, it's really what is the meaning of a banker. So, yeah. And then chapter 4 is really talking about Basel, talking about regulations, why we regulate, talks about um, a little insight about the different pillows. And like I said, I'm going to send you all a video on it. Same thing I did for money because it breaks it down and it shows you the different pillows and shows you how it really works. So,
With
like I
some
say,
of
you
our
could read
pages,
it, but once you see visual, what happened?
some of the pages in chapter 4
In chapter,
for
what happened to it?
like you read, you just don't go um okay. Chapter 4, the future of regulation. To the bottom, the problem facing greater regulation cooperation.
What they have chapter? What they have chapter for us?
Okay, if you look in chapter 4, the pages all are numbered
Uh huh.
4 to chapter 4, but they are
Oh,
on
I
the
see
bottom.
that.
Yeah.
I see that.
So you have to
That's
go
what's
back.
steaming.
Right.
Oh, yeah,
Mhm.
that's when, yeah, man, attention. Yeah, I see that.
Mhm.
Yeah, I see that. Yeah.
So that was a little like,
Yeah. So with chapter 4, who all read? Because Miss Sutherland,
Hi, good night.
you was not here, so you need to introduce yourself to us. Your
Okay, my
name,
name.
your
hmm
where you work, or just some information about you.
Okay, my name is Jagira Sutherland. I am currently employed at the Ministry of Education.
Hmm.
I'm a mother of three,
Hmm.
and that's about it.
Okay, what do you do at education?
Well, I currently work with one of the ministers. I'm his assistant.
Oh, that's good. You should have been working someplace else, like national insurance, so I
Indeed,
could
indeed.
get a hookup.
Yes, ma'am.
I retired from last year, and national insurance didn't give me $1 yet.
Well, I heard they trying to sort out that one.
Huh?
I say I heard they're trying to sort all of that out.
Well, I don't tell them. I write them a letter and tell them if they don't sort me, or I can be sitting in the minister chair. Don't fool with me.
I
Yeah.
blame you.
From last year, next month make me a year since I retired.
Trust me, I've heard it all. I've
Yeah.
heard it all.
And then when you call them, it's like they're doing you a favor. And
Yeah, most of.
yeah, customer service is so awful. Yeah. Hmm. Yeah, but yeah, so well, you and I think it's you and two others have to take the quiz, has to take the exam, the
Yes,
quiz.
ma'am. Yes,
So
ma'am.
we just have to arrange with Mr. Pratt once all of you come together so he can do it on one day. What day have you decided?
I'm leaning towards a Thursday, if that's okay.
Okay.
A Thursday evening.
Yeah, I'll speak with the other two persons because it's two other persons. Yeah, I'll speak with them.
Okay, ma'am.
All righty, you have your book, right, Miss Sutherland?
Yes, ma'am.
Did you have a chance to read?
Yes, ma'am. I've been doing that. I've been
Okay.
in chapter 2 at the moment. But I mean, I'm in chapter
Okay.
4 now. But so far it's
Okay.
chapter 2.
All right. Well, try to also take a look at the videos that I sent regarding chapter
Ma'am,
3, which
I
deals with.
already watched the videos.
Okay. All right. Were they informative?
Yes, ma'am. Definitely so.
Okay.
I've been trying to watch the classes now to get
Okay.
a better
All right then.
understanding.
Okay. Business of banking is the easier one. The next class I teach interest is risk management. That's a killer. Yeah.
Good night, Miss Smith.
Yes, ma'am.
You said you sent some videos on money.
Yeah, you should have gotten it. Everybody, I sent it to all of y'all that the videos on chapter 3,
mhm.
because remember I told y'all to read it, and then I send the videos so it'll break it down to y'all better. You didn't get it?
No, ma'am, I didn't get the review questions either. I had to get it from a classmate.
Okay. Well, I'll go back and look, and I'll
Okay.
send the videos to you.
Okay, thank you.
All right, and all of y'all got your results back, so y'all should be able to make sure y'all master those questions, because y'all will see them again.
Okay.
And midterm is on the 28th. So the ones that you get wrong, make sure you know the answer to them. Yeah. Okay. Well, chapter 4 deals with bank regulations. And like you would know, the regulatory body for us is the Central Bank of the Bahamas and the Securities Commission. We also have the Registrar of Insurance. So all of these companies, government entities that regulates financial institutions, mutual funds, investment companies, and insurances. Okay, Miss Rose here. Miss Wallace. Hello. Miss Wallace, are you there? So anyone want to volunteer to tell me what they gathered from the introduction regarding bank regulation? Hello? Hello? Everybody on? Good night.
Hi, Miss Smith.
Hi. Yeah,
What I gathered, basically is regulation. To have regulation is important because they want one set of rules that all financial institutions are to be governed under. That's what I gathered from it.
Right. And as we know, like it said, an agreement in 1988 known as the Basel Accord marked the start of international standard. It's a kind of standard that all central bank or regulatory bodies require that financial institutions, insurances, that they everybody do the same format. Say, for instance, like with central bank, where they have regulatory forms that have to be filled out every month, every quarter, and semi-annually and stuff like that. So everybody have to fill out the same form. So everything goes to the central bank. You complete these form, you'll have like the balance sheet, income statement, all of these reports, you also have to report on the non-performing, the 10 largest deposit accounts, stuff like that. So every bank will have to use that same form. Basel is Basel 2 now. I think Basel 3 should soon be implemented, but every bank has to use the same form, and everybody has the same reporting date that has to go to central bank, the bank supervision department that goes to central bank. Everybody. And like I think I mentioned before, if you're late, or if the form has an error, something that the bank should have picked up and didn't, there's a fine. You're fine if things are you're saying that, okay, it was 50, but when they look at the balance sheet saying 40, and when you add your totals all up together, you come up with 60. So what is happening? You're going to get fined for that. And if you don't correct the error, like say you pick it up and realize that, hey, before they tell you the error and you correct it, if you don't correct it in time, you're fine, and you could be fined $250 a day. So imagine if you didn't know that error and they didn't bring it to your attention, or a report wasn't submitted. The central bank makes their money too from fees that they charge. So since 1988, bank regulations have been an inevitable an evolutionary process. New regulations have modified previous regulations. So whatever they had before, especially after the credit crisis, everything changed because the banks the central bank around the world had to pay more attention to looking at ensuring that the credit crisis was managed. And like I mentioned before, in the UK, they had I'm not sure if I mentioned it to this class, the LIBOR, where they manipulate the LIBOR rate. And because of that, persons were qualifying for mortgages with a small salary because the rates was not correct, because they had, like, I think it was 2 persons in cahoots, and they manipulate the LIBOR rate. So when I would have only qualified for probably $200,000, because of the incident that happened with the LIBOR rate in the UK, I was able to qualify for 400,000, double what I would have been able to qualify. But when the investigation was done and it was found out, I think the persons went to jail, but everybody who got those mortgages at that rate, that lower rate, when the investigation was open, the rate was corrected, a lot of persons lose their homes, lose their lifetime savings, because they could have qualified, but when everything was corrected, they were not able to make that mortgage payment. So yeah. And so that's why when the credit crisis came, everything changed. You'd see even here, like for us, from the 2000, you'd see that our government introduced with the a lot of different acts. You'd have the Money Laundering Act, all different acts was introduced. New regulations have been modified previous regulations, but many of the approach used in previous regulation have usually been preserved. So they still keep them, but they don't use them anymore. In order to understand the current regulatory environment, it is therefore necessary to understand the historical developments. This chapter explains the evolution of the regulatory environment prior to the 2007 crisis. Anybody remember what happened with the crisis? What caused the crisis? And that was the credit crisis, with rates and everything going up. And like I say, a lot of people were not able to pay mortgages. And then you had a lot of non-performing, and, so that was the credit crisis. A lot of people lost jobs, and just like COVID, same thing with COVID, the mortgage playground now is where every time you look in the papers, somebody's going to court for, well, the bank take their house and now a settlement, and if they can't afford to pay, you get a certain number of days, the bank, you have to move out and the bank totally take possession of the house. And this chapter starts by reviewing the evolution of the bank regulations between 1980s and the 2000. It explains that the 1988 Basel Accord, now known as Basel. So the Basel Accord, so if I ask you a question, what the Basel one was called first? Netting provisions and the 1996 amendment. It then moves on to discuss Basel II. So we have Basel I, Basel II. Basel III been in the works forever, but I think central bank should soon release Basel III to the financial institutions, because that's been in the work a long time, which is a major overhaul of the regulations and was implemented by many banks throughout the world in about 2007. Finally, it reviews the Solvency II, a new regulatory framework for insurance companies, which is broadly similar to Basel II and is expected to be implemented by the European Union in 2016. Then we have what is regulations. Ms. Wallace, can you say for me what you feel regulation is? The term, what is regulations? Like with anything, we have regulations in school, regulations in banks, regulations in companies. And with anything, they regulate how we behave. Ms. Wallace?
Just like you say, regulations are in school. For example, you have to listen to the principal and stuff like that. So like you're taking rules from someone overhead, and following them.
Yeah. And like you have to make sure people comply. It's like compliance. Yeah. So the term regulation generally refers to a set of binding, it's a rule for both private or public body with the necessary authority to supervise. We know the central bank ensures that companies are in compliance with whatever sanction, and in every different jurisdiction, there's different sanctions. Every jurisdiction have different regulations, but in all jurisdiction, central bank regulates. Most industry sectors have some form of means by which they regulate exists. Regulation exists either in the form of board principles or the provisions of detailed rules and regulations. Many take the view that there is no need for formal external imposed regulations in any market, be this financial service or any other. And the essential self-regulated regulations by the various parties of the transaction will take place, resulting in the market finding its own balance. And as I say, regulation is formally imposed or informally opposed, agreed upon, and is intended to facilitate this. So regulation is needed anyway. You have a home, you have to regulate. You make sure that your children are in compliance with, you set your rules, and that's the central bank. They set rules. And when they set rules, financial institution, companies has to abide by those rules. If they don't, they're fined. And I think a lot of times some companies get fined a lot because you make errors, you get fined, you don't adhere to the practices that is set out in the Basel report, you are fined. So like anything, like I say, rules are to be followed, it's implemented, so it has to be followed. Ms. Roll, can you read the need for regulations for me, please?
why the need for government and monetary authorities want to regulate financial institutions so closely. We have to first look at the country and the money flow within, which also includes credit creation and the central trust that we show in the bank before we invest our life savings in them. The
When we
central,
talk, 1 second.
sorry,
We talked about credit creation. You remember in chapter 2, we talk about credit creation, how credit is created. Anybody remember?
That's putting up 10% for reserve.
Yeah, we have to make sure we have a reserve. Like it said, okay, we got $1,000, but we're gonna lend Miss Wallace 900, and we're gonna keep 10% to make sure we have the reserve. All banks have to have a reserve. That's liquidity. They have to have a certain percentage of reserve for, that's just a law, a rule. Because you don't want, like I mentioned before with Gulf Union, you don't want the bank to go away with everybody's money, close down, liquidate, and and so the central bank has to be monitoring to make sure that all banks is in compliance, just like we talked about with CLICO. CLICO, who was monitoring CLICO, that CLICO could have closed with so many persons' money was getting transferred out of the country. How is it and central bank or the insurance regulators didn't know? Yeah. Go ahead, Ms. Rowe.
the central bank and other monetary authorities regulate financial institutions to eliminate or reduce risk. Regulation to protect user and providers of financial services can aim at transparency of information and assurance for deposit. Such transparency can be at the level of the customer, such as advising the customer of any fees and commission that the provider will earn based on the customer choice of product is essential. This allows the customer to make more informed choices about products and compare them with other providers. This both aids competition and promotes fairness. There are rules which prevent insider dealing where bank staff or customer with private information about a company or issue share issue either buy or sell shares knowing that there will be a share price raise or fall when the news is made public.
Right. And remember, I spoke about that last class or the class before. I spoke about inside trading where we had that with somebody from Commonwealth Bank. So that's what it is when a staff knows that, oh, hey, the share's going up. So, hey, buy my shares now or sell now. Yeah, so that's inside trading. And like we know, we have so much, like I said before, we only had banks offering different products. Now we have insurance companies, investment companies offering the same services. So you can go to a Commonwealth Bank and open say a Christmas club, a term deposit. You can go to a bank in the Bahamas and do the same thing. Like everybody offer the same product and services, but what distinguish banks or any financial institution or company is, what do you think distinguish a company from the other? They all offer the same product, they all offer the same services, but what do you think would cause you to go back or choose to go to another bank, even though the bank that is offering you a higher interest, but you choose to go to another bank which is not offering you the same amount of interest? What would cause you to go somewhere else? Yes, Miss Roberts, customer service. Because I can come to a Fidelity and customer service is not what I am looking for, because I'm there my whole lunch hour, or the customer service rep is very rude. You know what makes customers feel good is when you go up to their wicket and they're able, what makes a customer feel good when they come to your wicket and you're able to say, "Hi, Miss Roll, how you doing?" You know, they feel special because they say, "Hey, he or she remembers my name." And that's what's killing our country today, because customer service, especially in the banks. I remember when I was in the bank and working frontline, customer service was the most important thing in the bank. If you gave good service, that's what mattered. I was a manager in Finco, and if I came down from upstairs and I came down and I saw the line was long, before I just waltz and pretended I don't see, you know what I did? I went to the counter and I would say, "I cannot give withdrawals, but I can accept your deposit." So you make customers feel appreciated, but we don't do that anymore. When you get in the bind, the line could be long, people in the corner gossiping, and nobody really cares. You know, before they say, "Hey, I don't have a customer. Hey, the line long. I can just take deposits." And, they don't do that. So you go to a majority of banks, people complaining about the service because nobody no longer think customers are important. And even in the loan section, you'd have, like, for a lot of banks, the only thing a customer does is give them money. It's like, oh, getting them to get the loan and that's it. It's like nobody follows up, check on customers to see, only time they do at majority of banks is when they're looking for business. "Oh, she almost finished paying her loan. Let me call her." So, but customer service is something that is lacking in most financial institutions today. Go ahead, Ms. Roll.
Though the wording and focus of specific objectives may differ from jurisdiction to jurisdiction and regulator to regulator, the essence of these objectives of regulation remain constant within the regulatory environment and are key consideration for all stakeholders in it. The recent global financial crisis has led to ever more emphasis being placed upon the achievement of these objectives. The mechanisms by which they are to be achieved are being revisited and in many cases are being found seriously wanting, encouraging a wide-ranging readjustment in approach and focus. The channels by which these objectives should be achieved at international, national, and sector levels are under ongoing scrutiny from many angles, mainly by governments, regulators, businesses, and consumers. The impact of this scrutiny and the changes it brings will be felt for many years to come as the regulatory environment adapts and no doubt adapts to reflect it. The objectives of financial services regulations are intended to create an open environment in which all participants or stakeholders can partake on an equal footing. Differing views as to which faltered first. Stakeholders in the financial services environment are not created equal, and as such, regulation is intended to level the playing field. Although all participants have right to expect a fair and open environment in which to undertake business, their actual needs vary. By broadly dividing financial services stakeholders into three main categories, their respective needs can be more clearly defined.
Anybody have anything to add to that? A lot of people making comments. Mona, you back? You here? What about you, Miss Strawn?
Hi, Miss Smith. Not yet.
Hi. Okay,
Not
Miss
yet.
Strawn.
In about 10 more
Okay.
minutes.
Okay, Miss Strawn, anything to add to that?
Miss Smith, I on the road. I trying to get
Oh,
home
you on
right
the
now. I
road
just
too,
missed
eh?
my dog.
Okay, all right,
Yes.
okay,
Okay.
all right. Um, Basel Accord, Bahamas. In 1992, the Bahamas implemented the 1988 Basel Capital Accord. The central bank monitors compliance with Basel I on a quarterly basis. And like I said before, they have reports, you have monthly reports, you have quarterly reports. Quarterly reports are, whoa, a lot of reports. And like I say, with those quarterly or monthly report, everything have to tie back into one report, because if you have something that is not correct on the balance sheet and you're trying to submit and it doesn't tie back to the other sheets, what is going to happen? It won't allow you to submit. To date, however, where am I? Hold on. Quarterly basis as part of the review of the financial condition. The quarterly reports tell central bank the standing of each financial institution. To date, however, the 1996 amendment to Basel I relates to the market risk and the netting arrangement have not yet been introduced. However, a capital charge for exchange control requirements and the limited capital market activities of banks in the Bahamas, the banks expect that domestic retail bank will be below the Basel I material threshold for market risk. Additionally, the liability driven nature of international offshore banks in the Bahamas had led to capitalization level which are considerably higher than 8% minimum risk asset ratio requirement. Therefore, for the majority of Bahamian licensees, the introduction of Basel II, which mandates an additional capital charge for operational risk, should not reduce the capital ratio of offshore international licensees to the level of concern. And like I say, you see, they say with Basel I, well, the capital adequacy amount that most company banks had to have was 8%. And they said with the introduction of Basel II, it would go up. And like I said, we spoke before to say that the liquidity for most banks here is determined, I guess, on their deposit size, the money that they take in, but the range is usually, it's more than 8%. I think it's 15%. I know in Cayman it's 15%. The bank has to always keep capital adequacy should always be at 15, a little above, but should never be beneath. And you'd see in Basel I, the key to the system is to maintain capital adequacy. This means each bank must have sufficient capital to match at least 8% of the risk. So if they're giving loans, we know loans are risky. We give a loan, yes. And as we know with COVID, a lot of persons, the bank, they were in good standing with the bank, but when COVID came, a lot of persons lost their jobs. So it was not on because of something they did not do, but it was like a disaster. It is something that beyond anyone's control. COVID came, hotels, businesses had to change the way they operate. And so a lot of people found themselves working less hours, or a lot of persons found themselves without a job. And so banks have to always ensure that they are able to maintain their capital adequacy, which would outweigh the risks. Capital. capital is balancing figure in the balance sheet and relates to the difference between asset and liability. It also represents the shareholders fund equity. For the purpose of the accord, it is split into tier 1 and tier 2. And you'd go further and you'd see what tier 1 capital. This consists of items such as equity and non-cumulative parental preferred stocks like goodwill is subtracted from equity. You have tier 2. This includes undisclosed reserves, subordinated debt, and general provisions, profit aside to cover provisions for bad loans. So in tier 2, so you have to make sure you see the difference between what tier 1 covers and what tier 2 covers. We know tier 2 totally deals with loan loss provisions. So it covers that for generally for provisions for profit put aside to cover bad loans. All financial institutions lending knows that some loans will default. So they have to make provisions for bad loans. So loans that, hey, say some loans be on the wish list because, okay, they get the loan, you see 2 months, they pay, and then the next month they didn't pay, and then you know, hey, watch it. So they become the loans that are on the watch list or the wish list to say, hey, these loans can go into default. And we know once a loan hit 3 months, we call it non-performing. So provisions have to be made for these non-performing loans. And with the non-performing loans, once a loan goes into non-performing, we know nothing goes to the interest. The bank don't take no money for interest once a loan becomes non-performing. And even when a loan becomes non-performing, after a while, you have active, they sometimes charge the loans off because they realize that, okay, this person was incarcerated, so hey, they can't pay no bill. Or this person got murdered and they were the only person on the account. There's no way to recoup the money. So these loans are inactive charge off. Then you have active charge off where you're trying to go after those people. Because, you know, some people, like we talked last class, that a lot of persons now work for government, and most financial institutions feel that government loans, government workers are the secure bunch. If I give them a loan, I don't have to worry, but it is that way no more, because we have a lot of people quitting their jobs and leaving their big bill for 70 and 80,000 and going to Canada, going to the US because they get a better salary, and they forget about these loans. So a lot of times these loans go in inactive charge off and active charge off, where they have the lawyers, you know, going after these persons. But you have people too who forget that, you know, I had a loan, I never paid it off, but I'm going to get another job, and they still don't even take the time out to say, you know, I need to go back to that bank and pay the loan now that I'm working. And I always say, I don't even understand how is it that a person's paying national insurance, what due diligence did the government really do, or financial institutions, but government? How is it that if somebody's paying national insurance, there should be some kind of scheme in place where you could garnish those persons' salary? Because in the US, once they learn that you have salary, you work it, your salary could get garnished. And what happens? They getting their money before you see your money, their money coming out, you know. Mr. Marshall, how are you? Hello.
I'm okay, and yourself?
I'm good. You work at Bahamas Mortgage. Give us some insight on tier 2 regards with non-performing, profit put aside to cover non-performing loans, bad loans.
Would that be like escrow?
Not escrow, you know, but you know, like the banks, most companies they put money aside to say, like I say, they have loans that they on the wish list, those ones that they see, oh boy, I thought this person would have been a good customer, but boy, look like they pay half of their mortgage this month, next month. And so we know that, hey, that person could default. And then we have those where, hey, the person ain't pay for 3-4 months. And so right off the bat,
Well, I know with us,
we say it's an unperforming loan. Mhm.
I know with us, we like, let's say for instance, we will continue to pay certain insurances and stuff to
Uh-huh.
you if you are in arrears or you still default, because we still have to keep the home insured in
Right.
case if a hazardous, a hurricane or some sort.
Right. And like that. So they're not paying their mortgage and you're paying their insurance. So what happens? What happens? You add that onto their mortgage, right?
Yeah, I think like you just said about the 3 months when it goes in
Mhm.
default, it doesn't go to the interest. It would just probably go back to paying.
It just keeps staying at the principal. And so
Yes.
it keep hitting that principle. So if when I went into default and my loan was probably 30,000, gee, if you have to be paying that for the next 5 years for me, you adding all them insurance onto that principle. And what happens then? And then
And the
whenever,
interest.
mm-hmm, Ms. Joy?
Yeah, I'm saying and the interest.
Yeah, so everything. And some people they get a better job or they're able to refinance. So when they refinance, all of that is added back together to you to give you that new loan.
Right.
And that's what a lot of times because banks pay people insurance, a person could be just but almost finished paying their loan, but because they were never able to pay the house insurance, um what they really owe is that add-on charge, that add-on, you know. Every month is add-on and interest adding on to that insurance they paying. So interest on top of interest. Yeah. And so, like I say, remember, Tier 2 deals with provisions for bad loans. Tier 1 deals with preferred stock, goodwill, and equity subtracted from equity. So if a question comes up asking you what is tier 1 or giving you an example of tier 1 and giving you an example of tier 2, you have to be able to distinguish. And you would see at least 50% of capital must be in tier 1. So you could have a question asking you that too. Okay, Ms. Storn, you're back. You're online now.
Yes, ma'am.
Hi, can you pick up on Basel 2 for me, please?
Basel II, 1988 Basel Accord improved the way capital requirements were determined, but it does have significant weaknesses. Under the accord, all loans by a bank to a corporation have a risk weight of 100% and require the same amount of capital. A loan to a corporation with a AAA credit rating is treated in the same way as one to a corporation with a B credit rating. Also in Basel I, there was no model of default cumulation. In June 1999,
Correlation.
cumulation,
Hold on, Ms.
correlation,
Strawn.
sorry.
Hold on, Ms. Strawn. I wanted just to ask you, when they talk about the AA credit rating and the B credit rating, at what point now is the Bahamas? What are we now? What rating are we at now?
I don't know.
I think we are at BB3 or BB something, and they
Yeah.
call us junk status. Never in history I ever dreamed that we would ever be at that, that rating. And I pray and hope that we can get out of that. We were so proud of, what we used to be at, and now
We still add
we,
that?
yeah, last time on Monday they downgrade us again.
Okay.
Remember, just to say the first part of this year or Yeah, they downgrade us again. Yeah, but when we first, when the election was just over, we got downgraded. Yeah,
Okay.
yeah. So I never dreamed we'd ever be a junk status, stable. Yeah.
Mhm.
Mhm.
Okay.
All right, Miss
You know what?
Sean. Yeah, you can go
In,
ahead.
in June 1999, the Basel Committee proposed new rules that have become known as Basel II. These were revised in January 2001 and in April 2003. A number of quantitative impact studies, QIS, were carried out prior to the implementation of the new rules to test them by calculating the amount of capital that would be required if the rules had been in place. A final set of rules agreed to by all members of the Basel Committee was published in June 2004. This was updated in November 2005. Implementation of the rules began in 2007 after a further QIS.
Okay, our rating now is um on in November 14, Bahamas sovereign credit rating from BB minus to B plus with a stable outlook. We have a
Okay.
stable outlook. Yeah, but like I say, Cayman has a good credit rating. Yeah, because Cayman dollars is more than US dollars. Yeah.
Mm,
Yeah, you go to Cayman with your little $100, that's $90.
okay.
Yeah. Okay,
All
Mr.
right.
Marshall, you wanna let's thank you, Mr. John. Mr. Marshall, can you 3 pillows for me?
All right, 3 pillars. Capital, adequacy, entire scope base 1 as credit risk, operational risk, market risk. 2, the supervisory review. 3, increased disclosure of information, also known as market discipline. These 3 pillars will ensure that all foreseen risks in bank are covered appropriately.
And like I
Three
say,
op-
they divide them. You'll see where capital adequacy um relates to 3 pillows is capital adequacy, supervisory review, increased disclosure, and you would see in Pillar 1, capital adequacy, you'd see it deals with credit risk, operational risk, and market risk. We know credit risk deals totally with loans. Then we have operational risk, which deals with how the company or the bank is running their operations, the different, like savings, checking, deposits, term deposits, and you have market risk. That too deals, the bank looks at, central bank looks at all of that too. So these are the things you have to remember, because if I come to you and I said adequacy, entire scope of Basel one, which type of risk is involved in this pillar one? Which type of risk is involved in pillar one? And then if I say increased disclosure, and I say also known as what? We see market discipline. Okay, Mr. Marshall.
3 options. 1, the standardized approach. 2, the internal rating based approach. And 3, the advanced internal based approach. The Financial
Uh,
Services Authority in the United Kingdom. The primary source of framework legislation governing the regulations of banking and financial services in the UK is the Financial Services and Market Act 2000. While the current UK regulatory framework derives mainly from the FSMA and related implementations, legislation, and rules, it also substantially influenced by and to some degree implements various European laws in which states minimum requirements from the regulations of banks and banking services in the European Economic Area, the EEA. An increasing proportion of the framework is established by the European regulations, which are the direct effect in the UK, which are of the direct effect of in the UK. In the particular regulations EU 575 2013 on the prudential requirements of the credit institutions of investment firms, capital requirements regulation, CRR, together with the directives 2013-36 EU on capital requirements, the capital requirements directive IV, CRD IV, which implements Basel III, the main primary
And-
source of cap butter.
No, I was saying, like I said before, Basel III won't be implemented and it will soon be implemented. Yeah, will soon be implemented. So that's a whole different new standards again, different approach, different forms that financial institutions will have to be completing in the Bahamas. And I think it's around the world because they all work, they all work on the same level. So I think introducing it here will be introduced around the world also.
The main primary source of capital, liquidity, and leverage requirements in the EEA.
Mona? Thanks, Mr. Marshall. Hi, Mona. Oh, Mona.
Hi.
Okay. Hi, you back? You home? Or still on the road?
5 minutes.
Okay. Okay. Natasha,
Yes, ma'am.
can you the legal and regulatory frame in the
In the
Bahamas?
Bahamas? Okay.
Mhm.
Legal and regulatory frame in the Bahamas. Banking is one of the most highly regulated industries in the country and often challenges us to remember the goals of our commitment to compliance. But if it means preserving the customer's rights, preventing illegal acts such as discrimination or criminal activities, and supporting the integrity of the customer relationship, then quote unquote compliance is more than just abiding by banking rules. It involves meeting our challenges with the delivery of superior products with unsurpassed quality, customer service, and in a manner that maximizes shareholder value. FSC Financial Bank Bahamas is located West Bay Street, New Providence, and the Bahamas FSC is financial institution which is regulatory by the Central Bank of the Bahamas.
What is what do you think FSC is?
I never heard of that.
Anybody?
Look like, and the Financial Securities Commission? No?
Financial Service Commission.
No,
Mm.
something.
Yeah. Yeah.
So if I have, let's say I get a mortgage to the
Mhm.
bank
Mhm.
and I feel like I didn't like something that the bank did. Procedure wise. So I
Mhm.
think, yeah. Who do I go to then to if let's say the bank don't give me no satisfaction. And is there somewhere in central bank that I go to, or where do you go?
No, I don't think so. See, and that's why you get a mortgage. Remember now, when you get a mortgage to the bank, you have your own lawyer.
Mhm.
The bank have their lawyer. You have your own lawyer. So your lawyer is supposed to be looking out for the best interest of you. So that is the reason why they say, okay, I buy a piece of property from you, but you telling me, oh, you could use my lawyer. Who would use your lawyer and I buy the property from you? Your lawyer ain't it's something untoward your lawyer ain't gonna tell me
Right.
because you're trying to sell the property to me. So that's what they'll always say. If you, because you have situations where I know y'all heard of stories where persons purchase a piece of property, start to build a house, and then someone come up and say, hey, how you building on my property?
Right,
Guess what? They gone through the lawyer, you know.
right. But
The
then they
lawyers,
sometimes
if
they
they
go to the same lawyer.
no, but they had a different lawyer. But if the lawyer didn't do proper due diligence, what
Right,
happens? The opinion of title. That is
right,
something that the lawyer has to, it's a whole list of things. They have to make sure that the property is the correct property. If it say lot C, block 3, you have to make sure that is what it says. A lot of
but I was
times you have situations where people have built on other people's property, and all the legal documents and everything has already been drawn up and signed, and the banks can give out some of the money, then pay the legal fees, and you find out
but
that
I had a
Mhm,
situation where I know of a situation where someone bought a piece of property and was paying for the
mhm,
property for years.
mhm.
And after COVID came and they start falling into financial problems, they decided that they're gonna sell this property. So now they've been paying the bank now, must be 7 or 8 years. And
Uh-huh.
so they when the person now during the legal work, they find out that this property even ain't their property, what they paying for all these years.
What?
Yep,
And who they pay in the bank?
the bank.
So the bank lawyer didn't, her lawyer and the bank, most banks now have internal legal counsel. So that
Right,
means none of them did the due diligence, because the bank lawyer should at least pick up something. Because most banks have
right,
legal counsel, in-house legal counsel now.
right now. And so now they battling this and it's taking long. Like the bank don't I don't know, the bank trying to say they're not responsible.
How the bank cannot be responsible when they hold the legal mortgage? How could they not be
Right,
responsible? They
right.
hold the legal mortgage. How could they not be responsible?
So do
That
they
means
have
their in-house counselor, what did she do? He or she did.
right? I guess they didn't make sure everything was done properly before they do the loan. So something like that. Do we have any bodies that we could go to, like a financial body, to say, listen, such and such is the case, or this is something for the lawyers to fight and court?
I don't know, I'd have to inquire, but I've never heard of anything that we can do that. I've never, because that's why I say, if I'm paying a mortgage to you, you don't think you're gonna ensure that I get that money? I get $100,000 from you to buy a piece of property. You don't think you're gonna ensure that that property has been, the title documents have totally been researched, and you've gone way back to wherever and make sure that it says the document, it was conveyed to from Miss Strawn to Andrea Smith. You can make sure whatever title document far back, you can make sure, all lawyers are supposed to make sure, and banks are supposed to make sure that they get all back title documents. Because you have
Right,
some title documents go back as far as 1920 something, but they have to make sure that they have all back documents
right,
and we know. So here again, these documents have to be recorded in the registry. So how is it they can say, because you have to stamp and record? So how they can
right,
say, I don't understand.
right,
And like I said, it's always the slackness on the lawyers. Yeah. They can't blame the customer, because two lawyers, the in-house counsel and then the customer lawyer. How is it that everybody ain't gonna pick up something?
now
And now they
because the
Mhm.
customer, the poor customer don't have money to get a lawyer
Oh. But he or she would have had a lawyer when
when
they
they did.
purchased the property, when they did the legal
Right,
work.
right. But
So she
now
need to go back to
when
that lawyer. She
now
needs
you
to sue
gotta
that
go
lawyer.
right.
And the bank need to also go to their in-house counsel and ask
Right.
what kind of due diligence they did to ensure
Now
that everything was in compliance. All right, continue, Miss Natasha.
The government of the Bahamas, the Central Bank of the Bahamas, and the Financial Intelligence Unit have passed and issued a series of anti-money laundering legislation, regulations, and guidelines designed to address the concern that certain monetary transactions may be attempts to launder money from illegal operations or finance terrorism. Among these legislative and regulative initiatives and guidelines are the following: the Proceeds of Crime Act 2000 and amendments, POCA. This act criminalizes money laundering related to the proceeds of drug trafficking and other criminal conduct and requires that financial institutions and their employees inform the Financial Intelligence Unit or the Commissioner of Police of any suspicious or terror-related transactions. The Financial Transaction Reporting Act 2000 and amendments, FTRA. This act makes it mandatory for financial institutions to verify the identity of existing and prospective clients, maintain identification and transaction records for specified periods of time, and report suspicious transactions.
Miss Augustine, you work at Scotia, right?
Yes, ma'am.
Right. So what is your procedure now if somebody wants to open a savings account? Who is that? Does that happen here, or your most of a handle aboard like some banks?
No, I think with the account opening, you
Uh-huh.
just provide the passport, NIB, and I think maybe a bill. It's not so strict as before COVID.
Okay.
Yeah.
Okay. So they relax some of
Well, you know, like how they usually want the bill to verify the address. I don't
Right.
think that is really mandatory right now.
Okay. All right. Right, because a lot of people got displaced and stuff like that.
Right.
And after Dorian too. Yeah.
Yeah. Once you have the valid passport and the NIB,
Mhm.
and I think it's like $50 or so.
Well, I know some banks is 500.
Yeah, some banks starting at 500, but I guess because of COVID too, because it was 300.
Okay.
Yeah.
Hi, Mona.
Hi.
Y'all still 500?
Yes, ma'am.
What? I was going to send somebody there. Then I remember I said, Charlie, I know you ain't got no 500. Well, how come you only relax your requirements? Y'all have plenty money here. Y'all totally liquidate.
No, they don't want too much
No.
unnecessary savings accounts.
No, we just don't want to waste our time. A lot of persons just open a bank account today, the $500 on there, next week the $500 gone.
But that's why I'm saying, why y'all want, probably if y'all had it a little lower, people will maintain it.
No, they
Some
cannot
people is
maintain it
waste
with
your
that on
time.
it. So why open at $50 when they can't maintain $50? So we give you a hard time to find the 500. So don't waste our time.
And then with the 500, it's no service fees, right? No maintenance fees.
Right, only the 40 cents for government stamp tax.
Okay, so but once it falls under that, do they have to close the account?
No, once it falls underneath the 5,000, they incur fees. But then they could, some people leave $20 on another account just for the fee, but that don't make no sense because after 4 months, that $20 gone.
Yeah, the fees eat it all up.
I think. Mm-hmm.
Yeah.
So if it's just for whatever purpose or whatever hype at that moment, leave it alone. Don't come to Fidelity.
But too now, Mona, remember now, sometimes persons working and things happen and they lose their job, so they have to come and get them a couple of dollars all the time. It wasn't, they opened it in with good intention, but they lost their job.
I don't believe that. I don't open accounts, so I don't know, but I wouldn't waste my time.
Okay. All right, Miss Natasha.
continue?
Yes, please.
Okay. The Financial Transaction Reporting Regulations 2000 and Amendments, FTRR. These set out the information financial institutions must obtain to satisfy customer identification requirements mandated by the FTRA. The Financial Intelligence Act 2000 and Amendments, FIUA. This act establishes the Financial Intelligence Unit, FIU, as the agency for obtaining, receiving, analyzing, and disseminating information related to the POCA and the Anti-Terrorism Act. The
What is the
financial FIU?
intelligence? Who is that? The FIU. What do they do?
They monitor most of our transactions, right, in and out.
What they do usually, like you would send stuff to like suspicious stuff. If you feel that, hey, this customer, you'll hear them say sometimes you have to file a SAR. You suspect the customer. Right. So they monitors that, and then like persons who funds get frozen, like drug dealers and stuff like that. They would send stuff out to all the banks to find out if people who get charged in court and the government seizing their funds sends names out, like I guess every month or every week, to see if this person have an account with the bank, and if the customer do, they would request different statements from the bank for this customer from inception. They want to know all the details, how this person was depositing. And so they're the stuff that they actually monitor. And you'd see persons who drug dealers, they would freeze all their money, and you would have to send all the information to FIU. Yeah. But they also there for when you suspect somebody for money laundering. Yeah. And you report it. And then a SAR is written up, and yeah. So they handle all those stuff, FIU. Okay, Mona, you back? Are you still on the road?
I'm going up the stairs right now.
Okay. All right, continue, Miss Natasha, for me.
Okay. The Financial Intelligence Transactions Reporting Regulations and Amendments 2001. This requires financial institutions to establish verification, identification, record keeping, and internal reporting procedures, including the appointment of a money laundering reporting officer, MLRO. They also require financial institutions to provide relevant money laundering training for staff members.
Do y'all have that at your bank? Most banks should have it, and I don't know if y'all is up to do all them old courses and stuff every time you look around what course you have to take. I'd be like, Jesus, didn't I just take a course?
Because sometimes one or two things change.
And then you'd be like, why didn't I take this? Man, the same old thing again with this old money laundering, listening to these people's stories, and boy, when you got to take that test and they tell you better pass. And if you won't pass,
you have to take it again.
So you got to keep taking that test, and then you must get reported. Oh, she didn't pass the test. What happened? And don't let you work in the branch and you're dealing with customers and opening them account and you're passing the test. Sometimes they give you those different scenarios and those tests. You'd be like, gee, what is this? And then there's so much information that you have to remember as you keep going through. And at the end of the whole thing, then you get this test asking you all these questions. You'd be like, but I remember all of that. And as long as you ain't get page 5, well, these pages, Mona is saying 4, 4, 4. So we're gonna be going on the type of financial risks. Yeah. But yeah, I didn't like that way. I had to be taking that test, and then a lot of people didn't even know who the MLRO was, and you have to do all that
training. A lot of people used to fail.
why do you think people fail knowing who the money laundering officer is?
They
Why?
didn't
I
pay
thought,
attention.
but I mean, I thought the money laundering officer, you'd actually see in the training, they tell you that, okay, so and so is the money laundering officer, so and so is the compliance officer, you know. But a lot of times people just don't get it right. But like I say, I so happy I gotta do that whole thing no more. What? I used to so hate that every year, but Gina, just take that again, take it again, something else again. Then you see them emails coming out telling you, but oh, you have 2 more days or something to take the exam. Yeah, I happy I don't have to do it anymore. All right, you could continue, Miss Roll and Miss Augustine, and after that, Mona will take over.
The Anti-Terrorism Act and Amendments 2004 as amended. This act criminalizes terrorist financing and mandates the reporting of related suspicious activities. The Transactions Reporting Wire Transfer Regulations 2008. FIU guidelines relating to suspicious transactions and the prevention of money laundering and the financing of terrorism, March 2007. Central Bank guidelines on the prevention of money laundering and countering the financing of terrorism, issued in draft March 2009. Bank and Trust Act 2000, which covers the licensing and governance of all financial institutions within the Bahamas.
Okay, thanks, Natasha. Now remember, you all see all these acts, so you know, you need to make sure you know what they all about, what they all represent, what year, because you will see these type of questions in your midterm exam. Any questions, any concerns before we go on to the type of financial risk? Who read anyway? How many of y'all had the opportunity to read?
I did.
Okay, anybody else? I gather not. Okay, well, like I say, it's quite boring when we have to read. I really want us to be to the point where we can, and like I think with everybody exam, and I send it back, I say, I want to be able to have a discussion. So, you know, I really, I infringe on you to try to read, so we don't have to do this reading. So I can go to every line and say, okay, Mr. Marshall, okay, Ms. Strawn, tell me what's that all about? Tell me what's that all about? That's where we need to be at, okay? We have exams for persons just joined. We have exam, midterm exam is on the 28th, and we have to be finished with chapter 5. I think I have from chapter 1 to chapter 5. Yeah, so we have to be finished with chapter 5. And like I say, I sent homework. So if you didn't get the homework, please message me. I gave everybody my cell number is 565-3685. Just message me. So like Natasha, you said you didn't get the review, nor did you get the videos. So I will send them to you when class is over. I will send them, and then I need you to check to make sure you got the assignment that I sent over this afternoon to you all.
Yes,
I think I got everybody email, and I think I sent it to everybody. Hi, Mr. Pickstock, how are you? Yeah. Yeah. Okay. Mona, can you, if you've read, can you give me some just breakdown on credit risk?
I didn't.
Oh, you didn't? Okay. Can you? No. Why y'all ain't read Valentine's
Yeah,
today?
it's my first time in a week.
Don't do that.
You know, I just told you that.
Valentine today. Y'all gonna go have it over the weekend today. All right, Mona. Types of financial risks.
Types of financial risks. Credit risk. Credit risk refers to the risk that a borrower may not repay a loan and that the lender may lose the principal of the loan or the interest associated with it. Credit risk arises because borrowers expect to use future cash flows to pay current debts. It's also never possible to ensure that borrowers will definitely have the funds to repay their debts. Interest payments from the borrower or the issuer of a debt obligation or lenders or interest payments from the borrower or issuer of a debt obligation or a lender's or investor's reward for assuming credit risk. When lenders
okay, we know if you're gonna lend money, if I come to you, Mona, and I say I need to borrow $50, you ain't sure I can pay you that back.
Correct.
You could add your interest on that too, and I'd be like, okay, yeah, lend me it with your interest. Yeah, I can give you $10 back, and so I can give you 60. But I tell you that because I want the money, but it no guarantee that I would pay you back. And every time I see you, I duck in you. Because I'd be like, gee, that's Mona. She can be asking for that money. And that's the same way people do, customers do, because they be like, oh, I ain't paying them. I ain't got no money. And so when you calling them, what happens? They ducking you. How many people, how many persons you know, customers you know, you see the wrecker running down the road with the car in the back, you be like, gee, that's a nice car. What happened? People ain't pay the car payment, so the bank send the wrecker. I know some people is dodge and duck the bank so much, they hide them cars so much. But the bank, yeah, they be to the wash house. Man, some of them cars you see, sometimes you go to the lot where they have those repossessed cars, and the car full of the people clothes, because they find the car at the wash house, they get the car, you know, so that's how it is. But people will duck and dodge instead coming to the bank and saying, you know, this is what happened, this is what I can afford to pay, work with me. People prefer to duck because they feel it's better to duck and to just sit down with your officer. And they always just tell you, hear them say, if you're having issues, come and make some arrangement with your officer, but people don't do it. All right, Mona.
Sorry. When lenders offer borrowers mortgages, credit cards, or other types of loans, there is always an element of risk that the borrower may not repay the loan. Similarly, if a company offers credit to its clients, there is a risk that its clients may not pay their invoices. Credit risk also describes the risk that a bond issuer may fail to make payments when requested, or that an insurance company won't be able to make a claim.
Yeah, because if a couple people, sorry, Mona, if a couple people say, what do you think happens when, say, for instance, right, like Hurricane Dorian, how many persons you think actually got claims from insurance company, got paid for claims to insurance company? Got anything? Like probably a lot of persons in Abaco. Majority of them, yeah, majority of them, their cars were third party. So what happens? The car was gone. The bank's still looking for their money. So, Mona, y'all had any like that where in Abaco where persons lost the vehicles or lost homes or whatever, but did the bank work with them, or what happened? Did they do refinancing? Do you know?
Ms. Smith, I hate annoying people, so because of that, I never touch that portfolio, so I cannot give a response. So I really can't say what they did, what they didn't do.
Yeah, because I know, what about you, Natasha?
Some persons, they claimed because the homes were insured.
No.
And then I have a customer, her home, it wasn't insured and it was under the threshold for the bank to insure it, but she was able to get a refinance
Okay.
for lower payments.
Okay. So did she have a home or it just disappeared?
No. When she sent me the picture, all my heart dropped. I feel so sorry for her.
Okay.
Just
So
but that was the foundation, just the floor. You only get to see the tiles.
Whoa, everything was gone.
Everything was gone. No structure, nothing.
Yeah. And then she have to refinance on top of what she have. Yeah.
But she said our church was assisting her to rebuild.
Okay. All right. All right, Mona.
Where was I? Credit. Okay. Credit risk are calculated based on the borrower's overall ability to repay. To assess credit risk on a consumer loan, lenders look at the 5 C's and an applicant's credit history, his capacity to repay, his capital, the loan's conditions, and associated collateral. Liquidity risk. Liquidity risk involves securities and assets that cannot be purchased or sold fast enough to cut losses in an volatile market.
Yeah.
Assets-backed risk is the risk that assets-backed securities may become, I know I'm pronouncing it right, volatile.
Yes.
If the underlying securities also change in value. The risk under assets-backed risk includes repayment risk and interest rate risk. There's too much risk going on.
But okay. Wait. Okay. Anybody ever purchase? Look. Okay. Most people have pension plan, right? And like I know where I worked before, they would have, okay, you can invest at the end of the year. They send out something and say these are the different investments you can invest in. We know, and like I said before, I'm old, so anywhere in the world I invest in anything that have high risk. We know the higher the risk, the more the return. The lower the risk, the less the return. So younger people invest in high risk securities. Older people, they invest in moderate or low. They be like, no, I don't need y'all. Say you purchase some securities for me, and when you purchase it, it was at $50. Now when I get my statement, it dropped to $35. No, I give you my $50. Now that security dropped to 55 to 35, it dropped. No. So risks, we take risks even when we have, like I said, with the pension plan, when you get it, if you want to invest in risky securities, then you take the chance, you may get more money in return, because say for instance, I may make more money than you, but I invest in low risk. So you invest in something that is high risk, so you get more returns than me, especially if the security just keep growing. But me, who just stayed at that low risk, I get $2 when you got $40. Yeah. So even though I may make more than you, your pension can grow faster than mine because you take the risk of investing in a high risk security. All right, Mona.
Changes in prices because of the market differences, political changes, natural calamities, diplomatic changes, or economic conflicts may cause volatile foreign investments conditions that may expose businesses and individuals to foreign investment risk. Equity risk covers the risk involved in the volatile price changes of shares of stocks. Investors holding foreign currencies are exposed to currency risk because different factors, such as interest rates changes and monetary policy changes, can alter the value of the asset that investors are holding. Market risk. Market risk is the possibility for an investor to experience losses due to the factors that the overall performance of the financial markets in which he is involved. Market risk, also called systematic risk, cannot be eliminated through diversification, though it can be hedged against. Hedging sources of market risk include recessions, political turmoil, and changes in the interest rates, natural disasters, and terrorist attacks.
So they tell you market risk can happen when any of these things occur. Like I say, these are the stuff you have to pay attention to. So you're gonna have to go back over this chapter to ensure that you understand. And like I say, I have a video. I just have to look for it. And it talks about all of this. It talks about regulations. It talks about market risk, operational risk, liquidity risk, credit risk. It talks about all of that. It breaks it down for you. Mr. Pickstock, thanks, Mona.
Okay.
You're with us, Mr. Pickstock?
Good night.
Good night.
Good night.
Can you read from, did you have a chance to read?
I read very little, but I did have a chance to read.
Okay. Can you continue with operational risk? Or what do you think operational risk is?
I guess basically a company starting up and operating, venturing out into fields, they're taking a risk financially, they're taking a risk, globally, just going out there and starting up. That's what I believe it is, operational risk, just starting a business from the ground up. That's what I believe it is.
Well, like with any companies, when we operations is an operational risk. Just as operating is a risk. Like especially when COVID happened. Like I say, it all could always stem back to a natural disaster when COVID happened. Stuff like that. You can read operational risk for me, please.
Operational risk summarizes the risk a company undertakes when it attempts to operate within a given field or industry. Operational risk is the risk not inherent in financial, systemic, or market-wide risk. It is the risk remaining after determining financing and systematic risk, and includes risks resulting from breakdowns in internal procedures and people systems.
Right, because
Operation.
1 second, Mr. Dixon. Okay,
Right.
like they say with operational risks, if policies and procedures are not adhered to, what can happen? Say, for instance, because persons do not do due diligence when they open an account, they didn't check to ensure that this person, they deposit a check, didn't ensure that, hey, this check could be fraudulent. A lot of times operational risk comes from that. Tellers not paying attention to deposit taken and you get counterfeit money, stuff like that happening. Internal controls not picking up, say, okay, this teller always have a difference, always have a difference. And nobody really paying attention to say that, okay, today this person had $100, tomorrow it dropped to 50, and it goes back up to say 150. what is the red flag there? Every day this person have a difference. Sometimes where people have the little small difference where all I say they borrow for lunch money. And that's why it's imperative in especially banks and businesses that they do spot checks at all times to ensure that tellers are in their limit. Because if there's a robbery, we know that you have to be at a certain limit. Everybody have top, bottom, your limits, which you should keep throughout the day. If there's a robbery, you know, banks, companies have monies insured and you're insured for a certain amount. So if I'm a teller and I have $20,000 in my bottom drawer, which should not even be in my timer, should be in my compartment. What happens if I have a robbery, but it's insured to the insurance company that I only have 5,000 in my bottom and maybe 1,000 in my top. But when the robbery happened, I had 20,000. What happens there? That's a risk. That's an operational risk because persons are not adhering to the policies and procedures that is set out in the bank's manual. The bank manual say this is what you should keep. You sign a letter with your limit to say this is what you should have. So right there, policies and procedures are not being followed. And if supervisors and managers are not paying attention or doing their due diligence by following policies and procedures that say that they should do spot checks on CSRs at a certain number of time through the week, then they are just as fault because they put the bank at risk too. Any questions? Any concern?
Okay, so in my line of work, we don't have no like just an insurable amount that we keep in our drawer. Basically because our drawer is always empty at the end of the day. So we don't have an insurable amount because we could always tell us on the barcode could always go over the limit at any time throughout the day. So we don't have that particular limit, whatever. But I do know that differences is always an issue. They always press that with us because they say the bank telling them that, oh, you ain't giving the customer their money, or the person short this amount, or the person ain't taking away the giving the customer too much money, and so it's a hard on, and it's always pressure. So I could understand why that could be an operational risk now looking at it, because I always be like, you down my neck, I didn't work hard all day, you down my neck for 50 cents, come on. But I understand why, so it is an operational risk.
Yeah. And like I say, people, systems, yeah. So, and sometimes people don't understand CSRs, don't understand, and they, like you say, you be like, I worked so hard today and you rolling me out for 50 cents. But like I say, people, even with counterfeit, a lot of times, I guess, persons don't put it under the little light and check it. And so what happens? Sometimes it's just a rush and people just don't do their due diligence, and that's what happens. Yeah. But do you deal with customers at all? Like, you don't deal with customers like how the banks deal with them like that, right? You don't have customers come to you. Yeah.
I don't know customers.
Okay. Yeah. Okay. If you continue.
Okay, all right. Operational risk can be summarized as human risk. It's the risk of a business operations failing due to human error. It changes from industry to industry and is an important consideration to make when looking at a potential investment decisions. Industries with lower human interactions are likely to have lower operational risk. Operational risk focuses on how things are accomplished within an organization and not necessarily what is produced or inherent within the industry. These risks are often associated with active decisions relating to how the organization functions and what it prioritizes. While the risks are not guaranteed to result in failure, lower production or higher overall costs, they are seen a higher or lower depending on various internal management decisions.
You can continue.
Reputational risk. Reputational risk is a threat or danger to the good name or standing of a business or entity. A reputational risk can occur through a number of ways, directly as a result of actions of the company itself, indirectly due to actions of an employee or employees, or tangentially through other preferable parties, such as joint venture parties or suppliers.
What is, we know reputational risk can go in anything, because it only takes one person to say, oh, don't go to that shop, or don't go to that bank. You know, a lot of times people, I remember when I first started working at a particular bank and I had on the shirt, the guy looked at me and he said, you just wait there? Oh, that, and he just started running on. I said, Lord. So, and you know, other people just join in with him. So, you know, one bad service from a customer, CSR or loan officer, or a not return call or stuff like that could go out there and people tell you, oh, don't go there. You spend your whole lunch hour on that line. And so it's a reputational risk. Little things can cause a business to lose. Little things. People, one little incident can cause bad reputation for a company. Last one, Mr. Victor.
I can say very good to hear that. Every time I go on a bank line, I come back here. These people say IBC. Legal risk. The risk that changes in the law could adversely affect a bank's performance and stability. A legal case or appeal could make some contracts void and the banks may be unsecured. Banks can be sued, a factor that can highlight poor bank practices.
Thank you. Okay.
Okay.
You can talk. Thank you. Yeah, but like I say, just make sure y'all know the different type of risks, because you will see that there. Regulated entities in the Bahamas by central bank and trust companies, commercial banks, credit union, bank, Bahamas Mortgage Corp, Savings and Loans Bank, Money Transfer, Western Union, Cash and Go, and Omni Flash Cash. All of these are regulated by central bank. Other regulators in the Bahamas are the Securities Commission and the Insurance Commission of the Bahamas. Who is in red? Everybody's red. Who am I gonna pick on? Ms. Roberts.
Good night.
Hi.
Hi.
Future regulation. Yes, ma'am.
Okay. Financial markets are global. Financial regulation has historically been domestic. This comes as no surprise since financial regulatory regimes fall under the umbrella of public law, developing a direct relationship with the sovereignty of each state. Even after the Great Recession, in the aftermath of which national regulators coordinated more consistently, there can be no absolute mutual interest and therefore no single binding rule book or international supervisors. The fundamental question is, can reputational blows provide the necessary leverage to force regulators to put in place regulations in line with international standards? Even when states do harmonize their law with the global norms, the adoption procedures are lengthy and complicated. It was deregulation that made finance global. A decade after the crisis, the international community is struggling to find a way to re-regulate the market as an aggregate, further enhancing its international nature. Differences surrounding the role of capital attraction and regulatory arbitration are making increased cooperation difficult. When it comes to financial regulation, not everyone is promoting the same agenda. First steps towards regulatory cooperation. The establishment of the Financial Stability Board was the first official step toward greater regulatory cooperation. Data reporting was enhanced, and Basel III incorporated methods to identify and gather information for important banks. The integration of data collection and analysis became vital in tracking risk. Before the financial crisis, the regulatory system faced one major challenge. Although the standard making procedure was international, the supervision of implementation was still domestic. The FSB and Basel Committee did not have the necessary international recognition to impose sanctions on states that did not comply. Neither institution had the legitimacy to supervise the implementation of the regulation. The repercussion of not adopting the regulatory rules was a reputational blow, which had immediate consequences on the prestige of the regulatory agencies and banking sector of non-complying states. The role of the International Monetary Fund, IMF, and the World Bank was critical, as those institutions actually exercised hard power, having the ability to decline lending to states that did not comply with the regulatory standards. It seemed that the international lender of last resort exercised enough influence over the borrower so as to force them to adopt the necessary financial regulations. The problems facing greater regulatory cooperation. It would not have been particularly strange for domestic supervisors to look favorably upon local banking institutions. Although this was a development that the FSB and the Basel Committee should have predicted, good faith and trust between the sovereign states outweighed the issue. On the other hand, G20 countries have set most of the regulatory standards, a fact that creates a serious problem of underrepresentation of some states' view. The intricacy in the structure of institutions, combined with the historical refusal of states to allow internationalization of fields, such as property and insolvency law, made the insolvency procedure painfully bewildering and slow, further enhancing the spread of the crisis. The main issues that arise are generally related to the unwillingness of the state to give up their power and bestow it is this supposed to be supranational? Supranational?
Yes, supposed to be supernatural.
Okay, supernatural or even international organizations. Even if such international agencies are established, will every country be represented sufficiently? If so, the process of rulemaking and supervision will be slow and counterproductive. If not, will every country's needs be adequately assessed? A roadmap for the future. States always try to attract capital, sometimes using deregulation as an enticement. This is a strong argument towards more binding international regulation. At the same time, regulatory arbitrage is perceived as a huge cost saver for many international financial institutions. Will those countries influenced by their clients be willing to be part of such international treaties as to create international regulatory organizations? Creating a level playing field can be adventurous. Even from a competition perspective, it is important, though, to make sure that the international rules do not favor the more prominent institutions. Regulatory and supervisory differences may have created barriers to the free flow of capital, but at the same time have allowed smaller local institutions to survive the extreme competition from international banks. Customs, cultural tradition, and finance need to be taken into account when integrating regulatory and supervisory regimes. Sovereignty and the different needs and goals of each state should be considered when constructing international organizations that make rules and oversee their implementation. With the development of genuinely multinational banks, soft law may not be enough to regulate the financial market. Principles-based law might provide the necessary flexibility in regulatory fields, but at the same time, it can allow counterproductive maneuvers on costly reforms Fragmentation of regulation and supervision minimizes the agility, hindsight, and rapidity of the reactions of the international community to global financial crisis.
Thank you. Okay. Want to ask a question. The exam that you had, how many of you actually listened to the video, watched the video? Hello? And how many of you actually really studied, especially chapter 3? Hello?
I listened to the videos.
How each of you, Mr. Pickstock, or
I read, I didn't watch the videos.
Okay. Mr. Marshall, you have to take the exam, right? Yeah, so can't comment on it. You have to take it. Another person have to take it. And Miss Sutherland has to take it, right, Miss Sutherland?
Yes, ma'am.
Okay, Mr. Marshall, is Thursday good for you?
Thursday is fine.
Okay, Miss Sutherland, you said Thursday, right?
Yes, ma'am.
Okay, so I'll just set that up with Miguel so he can finalize it. Okay, so we know that's chapter 4, which deals totally with regulations, risks, talk about the different risks, talks about the roadmap, talks about the Basel, the pillows, and type of risks, and then it talks about the future of regulation and the roadmap, the problems facing greater regulatory cooperation. And that's chapter 4. Any questions, any concerns on chapter 4? Because it's quite early yet. It's not even 8 o'clock. Hello?
I'll have to read it on my own because remember I missed most of the class, even though I was listening. But I'll have to read it.
Okay, but like I say, I'm going to look for the video. The same thing, it's good to watch the video, Mona. Even though you say you might have not, it's good to watch it because it fills in some gaps for you and it shows you how money is actually circulated. It shows you a lot of stuff. And
Okay.
so I'm gonna also send you the one that talks about this chapter 4. I'm gonna look for it and send it to you all also. But as you can see, chapter 5 deals with bankers, customer relation. It talks about what is a bank, the bank and customer relations, what is the meaning of a banker, and the different types of banks, the different type, what is a bank customer, I wish most of you should know because all of you in the banking, some of you in the banking system, well, Ms. Sutherland, you say you're in education, but you have to deal with the bank. So yeah, we talk about general relations, like people who owe debt, people who have like the creditor and the debtor. And then we have the trustee, the bailee, the bailer, the principal and the agent, the pawner and the pawnee. And like I say, this chapter is very, very easy because it's just recapping a lot about customer and the different types of bankers. So it's kind of really shorter. Do y'all want to start this chapter or y'all want to review the chapter at home, because we still have plenty of time. Hello, consensus?
Whatever.
We can start it.
Okay. Mona?
I second that.
Hi.
You want to start the class, start chapter 5?
I'm
trying to get a, that's what I'm saying, I'm trying to get a consensus, because I know all of y'all Valentine tonight, so. Okay, like I said, chapter 5 talks about bank and customer relation. In chapter 5, we see the bank and customer relationship. This is the relationship between the banker and the customer, which is very important. Both serve society to grow and the economy to expand. Before we can discuss the relationship between the banker and the customer, it seems necessary that the two terms banker and customers are made clear. What is a bank? Anybody?
Financial institution.
Yes, it is. A bank is a financial institution licensed to receive deposit, make loans. Banks may also provide financial services such as wealth management. We know that. We do wire transfers, safety. Some banks have safety deposit box. There are two types of banks. We have commercial and retail banks and investment banks. In most countries, banks are regulated by the national government or the central bank. Now we know we have the Bahamas Development Bank, which is government owned. We have Bank of the Bahamas, which is government owned. So any other banks that is government owned? Just those two, right? Then we have in the Bahamas, we have banks like Canadian banks, Royal Bank of Canada, First Caribbean, Scotiabank. Then we have Fidelity Bank, which is Bahamian owned. We have a Commonwealth Bank, which is Bahamian owned. We have the different investment companies, like we have CFAL, which provides financial services. Like I said, the last class, you could even open, up to the 24th of January, you could open up a ASU savings account with them and get your money in the end at December. When since you found that CFAL did that. But so everybody is out of the box. Nobody now just stick in the field that they're in. As mentioned before, banks basically makes money by lending at a rate higher than the cost of the money they lend. Most specifically, banks collect interest on loans and interest payment from the debt securities they own and pay interest on deposits and short-term borrowing. So we know banks make money from giving loans. They get interest. Bank pay money on interest on deposit accounts because they're using the depositors' money to give loans. So a lot of times you'd see some banks say, oh, we need to bring in some more money. Or you'll hear some banks say, oh, we need to lend out some more money. We're too liquid, so we need to give more loans. Banks provide various loans and advances to industries, corporates, and individuals. The interest received on these loans is their main source of income. Interest on investments, bank invests in various government and rated securities and earn interest and dividends from these government investments. Did y'all see what central banks say now about purchasing bonds from them? Anybody saw it in the papers? Central bank, before central bank usually placed the ad, say for They have some bonds that you can purchase for 10 years, 4 years at a certain rate, and you can purchase them. They tell you the date, the opening date, the closing date. Now, Central Bank has said persons who now have bonds investment with them, they will continue to facilitate it. But anybody coming new to the market wanting to purchase new bonds, like when it goes out there, if they would have to go through a brokerage firm like a Royal Fidelity, like a CFAL, like a Leno. They no longer can go to Central Bank and purchase bonds, government bonds and stuff anymore. Anybody read about that?
No,
No, I didn't, but thanks.
Yeah.
So what if you don't have a relationship with CFAL or Royal Fidelity?
Well, if you want to purchase government bonds, you're gonna have to have one. You're gonna have to open an account with them, a brokerage account. Yeah.
Oh,
they will no longer facilitate selling bonds to government bonds. You're gonna now have to get a brokerage account and go to the brokerage firms or investment companies to get bonds.
Okay.
What is the meaning of a banker? A banker is an employee of a bank or financial institution who serves the financial needs of clients. These clients can be individuals or institutions, both with different needs. A banker tries to maximize the profit of the bank while maintaining an appropriate risk level. And yes, we know, because with anything is risk. I'm taking in a deposit, I'm giving a loan, and that's why the central banks say that each institution has to maintain a certain capital adequacy, a certain amount of liquidity, because like I say, you can have a customer who have $1 million in the bank, and one day sickness happens, something happened, and they need to take 600,000 of that out. What can you do? That's why the bank have to maintain a certain amount leverage liquidity, so unexpected things can happen. You put somebody has $1 million on a savings account, they choose not to put it on a term deposit, even though you may pay them a higher rate. They leave it on a savings, and they can come and take their money at any time. They don't have to give you no forewarning. That's their money. So you have to always, banks have to always make sure, financial institution, make sure that they are liquid, they are able to pay when customers come to get their funds. Essentially, bankers raise capital to make loans and investment. Banks invest too, because you'd have banks, most banks invest in government bonds. So most banks invest in government bonds, different securities, when different like stuff come to market, like the port, some banks invest in that, people invest in it. So banks do investment too for a higher, for a gain. So they give loans and they do investments. Institutions include small business, large corporations, and government may seek regulatory advice, cash management solution, outside investment, and of course loans. Individuals need basic banking services such as checking, a savings account, and sometimes larger needs such as buying a home. Here is a simplistic example of how a bank handles the need. Mona, can you pick up there for me, please? We'll stop like about 8:15. I will let y'all go. But Mona, can you pick up for me, please? John is looking for a safeguard for his money.
John is looking to safeguard his money by depositing it at a bank. The bank agrees to pay John an interest rate of 1% for the use of John's deposited money. Mary, who is looking to buy a house, comes to the bank looking to borrow money for the purchase of the house. Through an application process where the bank analyzes Mary's income and credit score, the bank loans her the money. open bracket, from John's deposits as well as others, close bracket, and charges Mary 6% interest for the lifetime of the loan. The bank then takes the deposited capital and lends it out to Mary as a loan to buy a house, open bracket, known as mortgage close. The bank.
So you see how, hold on. So you see how the bank made money, right? What they paid for John? What they pay John? How much interest they pay John?
1%.
How much interest they charge Mary?
6.
So that's how the bank make money.
Correct.
They get John deposit for 1%. So how much percent? How much they gain on John money?
5%.
They take John $1 million, lend out the, and so imagine if they give John that 1%, he have $1 million in the bank, and they give him 1% on that. They take that same $1 million and lend like 10 people besides Mary at 6%. That's how the banking earn their money. So they take your money, pay you less, and lend out your money and gain more.
Mm-hmm. The bank makes their money on the difference between what they pay the depositors and what they lend to borrowers. Let's say depositors get 1% from the bank of their assets, and the bank loans out these deposits as mortgages at 6%. The difference between these two rates, the net interest margin, is 5% on a $300,000 loan. That equals $15,000 in interest per year. This is the profit on the loan for the bank per year, assuming the bank kept the loan on their books. Mortgage loans are typically 30 years in length, so this is profitable for the bank.
This is okay. So look at that. So a lot of times people go to the bank, they borrow $300,000. When you borrow $300,000 from the bank, you pay a 6% rate, and you see what the example says, $15,000 a year. So take 15,000 times that by 30. But the interest rate goes down every time. The principal is less. Not the interest rate, but the amount that goes to the interest and what goes to principal. The more you pay on the principal, the less the interest will be every month. So that's why it's good to make your mortgage payment and also put money to the principal. So it won't stick at 15,000 straight through, because the interest will drop, because the amount of interest you're paying every month will drop, because as the principal drop, the interest will drop. All right, Mona.
Okay. A banker is a dealer in the capital, or more properly, a dealer in money. He is an intermediate party between the borrower and the lender. He borrows from one party and lends to another. Banker has been defined as accepting for the purpose of lending or investments of deposits of money from the public, repayable on demand or otherwise, and withdrawals by checks, drafts, money orders, or otherwise.
Okay, thanks, Mona. The different type of bankers. Okay, what I'm gonna do, I'm gonna let y'all go, but I need y'all to finish reading this chapter, and we shouldn't have to go discuss this, not discuss, but we shouldn't have to be reading. The only thing I'm gonna do when I come back on Monday is to pick each one of you and ask you to tell me what personal banker is, what a commercial banker is, and that everybody is gonna have their opportunity to explain each area to me. We did a lot of reading today, which was very boring. We really need a live discussion. I missed that day that we had that was a good class, a live discussion. And like I say, that's the reason why we have to read. Chapter 4 was kind of, more in depth, but Chapter 5 deals totally with what most of us do on a daily basis in the banking system. So I'm going to really ask you to read because it's really straightforward. Rights of a customer, duties of a customer, to honor a customer's check, standing orders, secrecy of a customer's account, a bank due of care when giving advice. You know, when giving advice to customers, you have to be very careful because sometimes even with giving advice, customer can come back and say, you told me to do this. So that's why it's due care when you're giving advice to customers. So I'm going to ask you to please read over chapter 5 and ensure that you come to class just for discussion. I won't be asking anybody to read. I won't be reading. I want you to be able to, let's have a live discussion on Monday, because as you know, the following week is your midterm exam. So let's have a live discussion. Come with any questions or concerns that you may have for the exam coming up. And like I say, y'all have to, we have to have that discussion. Because like I say, with the quiz y'all got, I gave y'all a review as it wasn't exactly like what it was, but I gave y'all a review sheet as to review. And if I don't, like I say, y'all have to show me that y'all are reading. Other than that, it's no sense of me giving you a review sheet. I need you to read. So I try to make it easier for you by, you know, just giving you a sample of what type of questions could come. But I'm also needing you to read so you can come with a discussion. We can have a live discussion instead of just always having to read. That's not what it's all about. Our class should be just totally discussion. Let's discuss what is a bank, what is a customer. We should be able to just look at it and say, you know, I don't expect you to know the entire portion, but I expect you to be able to say to me, this is what I feel it is in your own word. Okay, and like I said, I gave you an assignment, and like I say, Natasha, you got your assignment?
Yes, ma'am, I got the assignment.
Okay, and anybody who didn't, I gave you my cell number. You can reach out to me and I will send it to you, but I think I got everybody. Yeah. I think I got everybody. Yeah, but would appreciate if y'all would take the time out and finish reading chapter 5 and come to class for discussion. And if you come to class and we can discuss, then I may think about giving a review sheet. If you don't, then I'm not going to. I'm just going to give you the midterm exam. And the questions that you've gotten in the quiz, you know, that's a part of the midterm exam. And I gave you, like I said, I gave a homework on which is due not Monday. It's due on Thursday. Okay?
Is there a time on Thursday?
No.
Okay.
Once you send it to me, Thursday, Friday the latest, I'm fine.
Okay.
All right. All righty. Good night.
Good night.
Good night.
All right. Good night.